Trading attracts many people with the prospect of significant income. On the internet, we see videos of traders showing expensive cars, yachts, and luxurious houses. This is what inspires many people to try trading. However, statistics shows that only a small percentage of people turn trading into a stable source of income, while the majority of people end up losing their investments. In this video, we will analyze the key rules that every trader should know in order not only to stay afloat, but also to achieve success in this complex field. Before we start, please leave a like on this video and subscribe to not miss more useful content about trading and ways to make money in the market. Let's start with the question, how and when to open a trade? This is one of the most common difficulties that beginner traders face. Everyone wants to open the first trade faster and see the first profit. But this approach leads to reckless decisions and eventually to losses. Every successful trader who has made trading his main source of income has a clear trading plan. The plan helps you stay disciplined and avoid impulsive actions that can cost you a lot. So, what does a quality trading plan include? 1. Defining market conditions. The first step is to analyze the current market conditions. It is important to determine if the market is in a trend or consolidation. Understanding the current conditions helps you choose an appropriate strategy and set goals. For this, you can use technical indicators and analyze support and resistance levels. 2. Criteria to enter a trade. All traders use different strategies and look for signals in different ways. So you need to find the criteria that are right for you. You can develop your own parameters for entry. These can be candlestick patterns, volume indicators, or price patterns. The main thing is that the criteria you choose should be clear to you and support your decision. 3. Determining your exit point. Successful trading also requires a clear exit plan. Specify the conditions for closing the trade, including target levels, take profit, and loss limits, stop loss. Remember that exiting a trade is as important as entering it. Well-thought-out exit points allow you to fix your profit and protect your capital in case of unexpected market movements. 4. Risk management. Define the acceptable risk per trade. Most traders set the risk at 1%, 3% of capital per trade. Before entering a trade, make sure your stop loss is in line with these values. If a trade exceeds your risk tolerance, skip it because capital protection is always more important than hypothetical profit. 5. Plan for difficult situations. Prepare yourself for the unexpected situations. For example, after several losing trades in a row, a temporary pause may be a reasonable solution. It will give you time to reevaluate the situation and help you to return to the market more focused. In such moments, it is important to keep your emotions under control to minimize the influence of stressful situations on your next decisions. Finally, the most important thing is to always follow your trading plan. The temptation to act intuitively or change strategies on the fly often leads to mistakes and reduces discipline. A well-thought-out trading plan helps minimize stress, maintain objectivity, and over time, develop your own strategy that will build confidence and lead to stability. Once you have chosen your entry points and have clear conditions for opening trades, you may find yourself exceeding your risk tolerance, both per trade and per trading day. Therefore, the next important aspect of our topic is risk management. Remember that risk control is one of the basics of successful trading. This rule will protect your capital and help you keep your cool in any market situations. Risk parameters per trade and per trading day can be different for everyone, but the classic recommendation is to allocate 1% of the deposit per trade and no more than 3 to 5% for the whole trading day. As soon as this daily value is exceeded, set yourself a strict rule. Do not trade any more that day. Of course, it will be difficult emotionally. At such moments, there is a great urge to win back, because losing money may cause a desire to return it immediately. To show you what can happen if you exceed the acceptable risk, let's look at a mathematical example. Suppose you decide to increase the risk per trade from 1% to 2%. It seems to be only 1%, but losing 10 trades in a row will result in a loss of not 10%, but 20% of your deposit. If the risk rises to 3%, the losses increase even faster. For the same 10 losing trades, you lose already 30%. Thus, small deviations from the plan in the long term. It is also important that each your trade is accompanied by a stop loss. Beginners are often afraid of losses, and in an attempt to avoid them, they break the rules, even moving the stop loss as soon as the price gets close to it. They may remove it altogether, hoping that the market will turn around. But such tactics usually lead not to profit, but to significant losses. Do not move the stop in the direction of increasing losses. It breaks the trading plan and brings chaos in decision-making. Losses are part of the trading process. Success depends not on their complete absence, but on the ability to control them. Leaving a stop loss in the same position makes you realize how much you can lose, and it helps you maintain objectivity and reduces stress. Disciplined use of stops over time creates a stable system that protects your deposit, especially during periods of high volatility. One of the key aspects that beginners rarely think about, but which plays a huge role in successful trading, is emotional control. Emotional management is just as important as money management. Let's find out how to keep cool and what will help you develop self-discipline. Emotions are a trader's main enemy. The most insidious of them are greed and fear. After a series of successful trades, traders often feel overconfidence, and greed begins to push them to take risks that go beyond the plan and strategy. There is a desire to double profits or take a winning path without clear signals. And when a trade does not go according to the plan, instead of objective analysis, fear comes into play, because of which the decision to close an unprofitable position is often postponed, and the trader waits for a market reversal, which may never happen. It is especially difficult not to give in to emotions after a series of unsuccessful trades. If you see losses that were fixed by a stop loss, just take it as a natural part of the process. Even experienced traders face losses. It is important to remember that discipline and a systematic approach to each trade will bring positive results much more often than trading on emotion. How to deal with emotions in trading. 1. Keep each trade within the framework of your strategy. Even if you want to change the plan in the process, remember, your strategy is worked out exactly for the conditions that you have predetermined. 2. Develop a rule of pause after losses. Give yourself time to cool down and only then analyze the situation. Trade chasing losses is one of the most common mistakes that lead to big losses. 3. Use stop losses and take profits. These levels limit your losses and fix your profits in advance, which helps you keep your cool and maintain your plan. For those who find it difficult to control emotions, the OWL Smart Levels Trading Indicator is useful. This trading system finds entry points on its own and sends a notification as soon as the conditions for entry are fulfilled. You only need to confirm the trade, and the indicator will set stop loss and take profit. This system helps to minimize the emotional impact on trading as you follow a strictly proven methodology. Another tool for controlling and analyzing emotions is a trading journal. A trading journal is your personal textbook and a mirror of your progress. Write down every trade, why you opened it, what factors you focused on, how you felt at the moment of trading, and what the result was. Over time, the journal will help you see unobvious mistakes and successes, as well as find patterns in your decisions. Benefits of keeping a trading journal. 1. Analyze your mistakes. A journal helps you see mistakes that are difficult to spot on the fly. 2. Approach correction. When you understand what steps led to losses, you can avoid similar situations in the future. 3. Emotional discipline. By fixing a trade and seeing a concrete plan, you are better able to control your emotions and treat trading as a job rather than a gamble. Keeping a trading journal is an important self-analysis tool that makes your progress visible. The more notes you keep, the easier it is to keep track of your achievements, correct your approach, and develop self-control. And remember, your main task is to build a stable trading system and stick to it in any market conditions. The last thing you may need on your way to profitable trading is self-learning. In trading, learning never ends with the first successful trades. On the contrary, real growth begins when you regularly invest time and effort in your development. Why is learning important? Financial markets are dynamic, and strategies that worked yesterday may no longer be relevant tomorrow. Not only does a trader need to stay updated with new tools and approaches, but they also need to constantly improve their skills to stay ahead of the curve. Constant learning will help you develop your market vision, adapt to new conditions, and improve your efficiency. Remember that trading is a marathon, not a sprint. Only through constant development and investment in your education will you be able to achieve sustainable success in the market. Even experienced traders continue to learn and improve their skills, which helps them stay on top. Following these simple rules creates a solid foundation for confident and stable trading. In trading, where there are no 100% guarantees, discipline, risk management, and constant self-development are your main allies. These principles will help you minimize risks and gradually improve your results. Don't forget that success comes with experience and patience, and each step in your development brings you closer to mastery. Apply what you have learned, don't stop at what you have achieved, and always remain open to new things.